The data is in. A 50% surge in oil prices has just kicked off what looks like the greatest supply disruption in history. And guess what? Central banks, they're already starting to walk back their promises.
So let's be crystal clear about what this number means. This isn't some wild prediction. This is the year-to-date surge in Brent crude. It's already happened. It's a direct result of military action that kicked off in the Middle East on February 28th. You know, a shock like this, it changes absolutely everything. And look, don't just take my word for it. This isn't me being dramatic. That quote, that's the official word from the International Energy Agency. And the reason is simple, but it's massive. The Strait of Hormuz, we're talking about the choke point for almost a fifth of the entire world's daily oil supply. It's basically shut down. So what does that actually mean for the markets? Well, for starters, all those coordinated rate cuts everyone was banking on, yeah, they're off the table now. The whole global growth story, it's just been completely derailed. So today, we're going to dig into the data and show you exactly what the institutional giants are buying to navigate this incredible shock.
All right, before we go any further, just a quick but important note. Everything we're talking about today is based on data-driven analysis. It is not investment advice. Every single investment comes with risk, so please make sure you consult with your own professional advisors.
All right, let's start with how this whole thing spiraled out of control. The data is pretty wild. It shows how the shutdown of just one single choke point sent policymakers into a complete, full-blown global panic. I mean, look at how fast this all happened. The escalation was just insane. It all starts with military action, February 28th. Less than a week later, boom, the strait is a no-go zone for tankers. 5 days after that, Brent crude smashes through $104 a barrel, and by early April, it's already climbing past 106. The sheer speed of it all left central banks flat-footed. They had no time to strategize, only to panic. And that panic has put them in what the data calls a stagflationary pincer. And trust me, this is the absolute nightmare scenario for any central banker. They're trapped. They're being forced to pick their poison. Do you fight this crazy energy inflation by keeping rates high and risk-crushing the economy? Or do you cut rates to try and save the slowing economy, but just let inflation run completely wild? There's no good answer here. And this table just shows you the chaos perfectly. That idea of coordinated rate cuts, it's dead, gone. The US Fed, they're looking at the sticky inflation and they've slammed the brakes, holding rates firm. Then you have the Bank of Japan, absolutely terrified of importing all this energy inflation, and they're signaling aggressive hikes. And the ECB, they're basically frozen, totally paralyzed and just watching the data. It's every central bank for itself now. But you know what? The energy shock is only half the story. There's a financial war happening here too. The tiny bit of traffic that is getting through the strait, they're being forced to pay for passage. But not in US dollars. No, they're being billed in Chinese yuan. This isn't just some random fee. It's a very calculated, very direct move to create structural de-dollarization, and it's aimed right at the heart of the US financial system. Okay, so you hear all that, geopolitical crisis, supply shock, financial warfare, and you think, okay, traditional safe havens must be going to the moon, right? Well, they're not. Let's dig into the data and see why the old playbook just got completely shredded. Take a look at this number. That was the price of an ounce of gold in early April. I mean, this is after it had already smashed through $5,000 an ounce earlier in the year. It fell a sharp 2.7%, and it did it at the exact moment geopolitical fear was peaking. So what on earth is going on? This is what we're calling the gold paradox. The expectation was textbook simple, right? A huge crisis should mean everyone piles into the safety of gold. But the reality? Well, it was a lot more complicated. See, that oil shock created massive inflation fears. That, in turn, forced the Fed to signal that interest rates would stay higher for longer. What does that do? It makes the US dollar surge. And for big institutions, when you can get a great, safe yield on US bonds, why would you hold a non-yielding asset like gold? It just becomes way less attractive. And that's the key takeaway right there. The rules have fundamentally changed. In this new macro environment, the data shows that the hunt for monetary yield, backed by a strong dollar and a hawkish Fed, is now a much bigger driver for institutional money than the traditional fear that usually sends them running to gold. Now, we have the data that points to the exact catalyst that will signal when this whole trend reverses. So, if you want to know precisely when this flips, you need to hit that subscribe button right now, before the algorithm decides you don't need to see this critical data. Okay, so if the smart money isn't hiding in gold,
Where is it going? The data is showing a huge, massive pivot out of the traditional stuff and into a very specific and pretty interesting set of alternative assets. So in early April, we saw futures for both the S&P 500 and the Nasdaq 100 pull back. And while some retail investors might see that as a dip to buy, the underlying data shows something else entirely. It shows institutional capital is actually leaving the broad indexes. They're treating any little rally as a dead cat bounce, just a temporary blip before the market heads down even further.
So where's all that money flowing? It's going into assets that are kind of shielded from all this market chaos. We're talking about massive institutional flows into things like the physical infrastructure behind the cloud, data centers. We're seeing it go into supply-constrained multifamily REITs, critical infrastructure projects, private credit, and even some very, very specific AI-themed investments. These are the new safe havens. And when you stop and think about it, this makes total sense. The whole AI revolution, it isn't some short-term bubble. It's a huge, long-term transition that requires building tons of real, physical infrastructure. Companies are pouring hundreds of billions of dollars into data centers just to keep up with demand. We're talking about real, tangible assets that are absolutely essential, no matter what the Fed decides to do next month, and no matter where oil prices end up.
All right, now for the part you've been waiting for. At the very start of this, I promised I would reveal the specific catalyst that the data points to for a rebound in precious metals. It's time for the payoff.
So after everything we've seen, this huge shakeout, what is the one precise thing that will signal it's time to start looking at gold and silver again? Well, the answer is actually pretty simple, and it's directly connected to the very thing that crushed them to begin with.
The catalyst? It's all about the exhaustion of the US dollar's massive surge. We're talking about the DXY, the US dollar index, which measures the dollar against a basket of other major currencies. That strength in the dollar is the exact reason gold became so unattractive. The data clearly indicates that the rebound for precious metals is basically waiting for the DXY to peak out and start to reverse. And that's likely to happen once the market feels like it is fully priced in the Fed's higher for longer stance.
So here's the bottom line. The signal to watch for isn't a peace treaty somewhere or a sudden drop in oil prices. The real signal is the peak in the US dollar. The data points directly to an imminent pivot for precious metals as soon as that peak is confirmed.
Look, this whole macro shock has completely rewritten the investment playbook. If you want to see exactly which global ETFs are actually holding the line and paying out some massive yields right now, click the video on your screen immediately.